Ladies and gentlemen, I need your full attention right now because what I'm about to tell you could affect every dollar you've invested in gold and silver. The LBMA and COMEX just released news that has the potential to shake these markets to their core. If you hold precious metals, you cannot afford to ignore this. This isn't speculation. This is the market revealing its hidden vulnerabilities. And history has shown us that when the system cracks, it cracks fast. Ladies and gentlemen, what's happening right now in the precious metals market is unlike anything most investors have seen in years. I'm not talking about the routine ups and downs of gold and silver, the daily charts, or the minor fluctuations that make traders nervous. I'm talking about a seismic shift, an event that could rewrite the rules entirely for anyone holding these metals. The announcements coming out of LBMA and COMEX are not minor footnotes. They are flashing red signals in the global financial system, and if you own gold or silver, you need to understand the urgency because this is a situation where hesitation could be costly. For decades, gold and silver have been the ultimate safety net. They're the assets people turn to when confidence in paper currency falters, when central banks overreach, or when geopolitical tensions rise. Investors have believed in their stability, their intrinsic value, and their ability to protect wealth during times of uncertainty. But the truth is, the markets behind these metals are not immune to shock. They are highly leveraged, interconnected, and vulnerable to rapid destabilizing events. What LBMA and COMEX just signaled is that the underlying plumbing of these markets, everything from supply chains to settlement procedures, is under stress. The systems we trusted are showing cracks, and if those cracks widen, it can happen faster than anyone expects. Think about this for a moment. In normal conditions, the price of gold moves in response to supply and demand, interest rates, and inflation expectations. But when you introduce stress into the system, hidden leverage, sudden shifts in inventory, regulatory changes, the market's response is amplified. One small disruption can cascade into massive price swings. And make no mistake, the signals we are seeing now are not small. They are significant, and they carry consequences for every investor holding physical metals, ETFs, or futures contracts. This is where urgency comes into play. When the market starts to behave unpredictably, those who act quickly have an advantage. Those who wait, thinking the system will continue as it always has, risk being caught in the fallout. We've seen it before, investors lulled into complacency, convinced that gold and silver are untouchable, suddenly facing margin calls, liquidity issues, or price collapses that wipe out paper gains in a matter of hours. The difference between survival and loss is often timing. Recognizing the signals early and acting decisively is not optional, it's essential. What makes this even more critical is the global context. We are not dealing with a localized issue. This is a systemic matter. Central banks around the world are juggling debt, inflation, and currency stability. Political instability, trade, tensions, and economic uncertainty are all intersecting with the precious metals markets in ways that magnify risk. The announcements from LBMA and COMEX are not isolated. They are a reflection of these pressures. They tell us that the system is being tested. And when a system is under test, volatility is not just probable, it is inevitable. Anyone waiting for a calm period to make decisions is already behind the curve. And let me be clear, this is not about speculation or fear-mongering. It's about understanding the mechanics of the market and the signals it is sending. These metals do not operate in a vacuum. They are deeply connected to global finance, and sudden changes in regulations, settlement rules, or liquidity can trigger chain reactions. When you understand the stakes, urgency is not an emotion. It's a strategic response. You evaluate your exposure, consider contingencies, and prepare for both downside risks and potential opportunities. The market doesn't wait for anyone, and in moments like this, neither can you. So if you own gold or silver, take this seriously. Pay attention to every announcement, every regulatory adjustment, every shift in inventory reporting. These are the signals that precede market shocks. The opportunity to protect your wealth or even profit from volatility exists, but only for those who are alert and willing to act. Hesitation can be expensive and in some cases devastating. This is the reality of the markets today, interconnected, fragile, and capable of rapid extreme movements. The time for complacency is past. The market is signaling stress, and stress demands attention. Understand what is happening, recognize the urgency, and position yourself accordingly. The announcements from LBMA and COMEX are not just headlines, they are warnings. And in moments like this, understanding the warning is the difference between being blindsided and being prepared. What we are seeing in the precious metals market is far more than price fluctuations or normal market behavior. This is a window into the hidden fragility of the global financial system. Behind the charts, behind the numbers, lies a complex network of leverage, derivatives, and counterparty risk that most investors never see. LBMA and COMEX are not just issuing routine updates, they are revealing the structural weaknesses that can turn a seemingly stable market into chaos overnight. This is the essence of systemic risk, the invisible threads holding the system together, capable of snapping when stress accumulates. Systemic risk is not theoretical, it is very real, and it has very real consequences. Consider the mechanics of gold and silver trading. On the surface, these are physical commodities. Investors buy them to preserve wealth, hedge against inflation, or gain exposure to a safe haven. But the reality is that the vast majority of trades happen in paper form. Futures contracts, ETFs, swaps, and these instruments rely on the solvency and integrity of counterparties, banks, and clearinghouses. A disruption at any point can cascade through the system. A default, a sudden regulatory adjustment, or even a minor operational failure can trigger margin calls, liquidity crunches, and a dramatic repricing of metals. The system is like a high-rise building built on hidden faults. From the street level, it looks solid, but shake the foundation and the upper floors start to collapse. What LBMA and COMEX have revealed is precisely where some of those cracks are forming. It's not always about headlines or rumors, it's about understanding the levers behind the curtain. For instance, when there are shifts in how metals are allocated, moved, or settled, it affects trust across the market. Settlement delays, discrepancies in inventory reports, or concentrated holdings in a few hands can create vulnerabilities that amplify risk. One participant's inability to meet obligations can ripple into a chain reaction, forcing other market players to adjust, often in panic. And when panic sets in, prices can swing violently, liquidity can vanish, and what was once considered a safe haven becomes a trap for the unwary. Systemic risk also connects deeply with broader debt levels, central bank policies, and currency instability all interact with gold and silver markets. When governments borrow heavily, manipulate interest rates, or engage in aggressive monetary policy, the consequences are not contained. They flow into every corner of finance. Precious metals are often the first to signal these stresses because they reflect confidence, or a lack of confidence in fiat systems. When these signals intensify, it is not just a market correction. It is a warning that the underlying system is under duress and the ramifications can extend far beyond the price of an ounce of gold. Another critical aspect is leverage. The metals market is heavily leveraged, and leverage magnifies systemic risk exponentially. A small trigger, whether sudden spike in margin requirements, regulatory pressure, or geopolitical uncertainty, can force rapid unwinding of positions. When that happens, the consequences are not isolated to individual traders. They cascade through the banking system, clearing houses, and ultimately into broader financial markets. What seems like a small disruption in London or New York can end up causing dramatic ripples across Asia, Europe, and beyond. For investors, recognizing systemic risk is more than understanding volatility. It's understanding fragility. It's understanding that the system we rely on for security is not as robust as it appears. And here is the crucial point. Systemic risk does not announce itself in calm headlines. It reveals itself subtly through minor disruptions, anomalies in reporting, or unexpected shifts in policy. Those who spot these signals early can take action to protect themselves. Those who ignore them do so at their peril. This is why urgency and insight must go hand in hand. Knowing there is systemic risk is not enough. You must understand how it manifests, where it concentrates, and what actions could trigger cascading effects. In the world of gold and silver, preparation is everything. Those who understand systemic risk can adjust allocations, secure physical holdings, and position strategically for potential turbulence. Those who underestimate it may find themselves exposed when the market moves faster than anyone anticipated. The announcements from LBMA and COMEX are a stark reminder that markets are not just numbers on the screen. They are complex systems intertwined with finance, politics, and human behavior. Systemic risk is always present, often hidden, and sometimes explosive. Recognizing it is the difference between being blindsided by chaos and navigating it successfully. In the coming weeks, these signals will become more pronounced, and the decisions investors make now will determine whether they protect their wealth or suffer losses they could have avoided. In times of market disruption, the first reaction for many investors is fear, and fear is justified. When prices swing, when liquidity tightens, when regulations shift overnight, it can feel like the ground is falling out from beneath you. But history and experience have shown that for those who understand the dynamics at play, turbulence is not just a threat, it is an opportunity. What LBMA and COMEX have revealed is more than just risk. It is a chance to position yourself strategically in a market that is about to see increased volatility. The difference between those who profit and those who lose will be preparation, insight, and decisive action. Opportunities in gold and silver markets rarely appear as headlines. They emerge in the subtle details: changes in settlement rules, shifts in inventory reporting, anomalies in price spreads, or regulatory adjustments that create short-term imbalances. These are not obvious to casual observers. They require attention, knowledge, and a willingness to act. This is where the advantage lies. While many investors react after the fact, the informed act before the chaos becomes obvious. Timing is critical. Acting too late can erase gains or even turn a strategy into a loss. Acting strategically, however, can provide outsized rewards. Consider leverage and positioning. Many participants in these markets are leveraged, highly leveraged, and any disruption can force them to liquidate positions rapidly. When that happens, it creates temporary dislocations in price. These dislocations are not mistakes, they are opportunities. Investors who are unleveraged or who have the ability to move quickly can take advantage of these price inefficiencies. Buying during a temporary dip caused by forced selling or selectively reallocating between gold and silver can allow an investor to acquire real assets at a relative discount before the market stabilizes. Another opportunity lies in understanding the interplay between physical metals and paper instruments. While futures contracts and ETFs dominate the headline trading, physical metals remain the ultimate hedge when systemic stress rises. Confidence in paper instruments can waver, and those holding physical gold or silver can find themselves in a position of strength. This is not theoretical. It is a pattern that has repeated itself in every financial crisis over the past century. Those who recognize the signals and ensure that their exposure is in assets that cannot be printed away have a distinct advantage. Global macro conditions amplify these opportunities. Inflationary pressures, central bank interventions, currency devaluations, and geopolitical uncertainty all create conditions where gold and silver can outperform other assets dramatically. When the LBMA or COMEX releases news that impacts supply, delivery, or trading rules, it is not just an isolated event, it is a catalyst that interacts with these broader conditions. Investors who understand this context can make moves that are not only protective, but also strategically profitable. The key is to recognize the conditions early and act before the broader market fully comprehends the implications. Risk management is part of the opportunity. By allocating strategically, hedging exposures, and understanding how derivatives and leverage amplify market moves, investors can turn what seems like chaos into a controlled advantage. It is not reckless speculation, it is disciplined strategy. Those who panic lose. Those who wait too long miss the window. Those who act intelligently with full awareness of systemic pressures and market dynamics can take positions that protect wealth while positioning for upside gains. Timing, again, is everything. These windows of opportunity are fleeting. They do not last days, and in some cases, they do not last hours. When market shocks hit, liquidity moves fast, spreads widen, and prices adjust in ways that can be dramatic. The advantage goes to those who have anticipated the move, have the resources to act, and are mentally prepared to execute without hesitation. This is where preparation meets opportunity. The announcements from LBMA and COMEX are a signal that the market is entering a period of heightened activity and volatility. Those who treat these developments as mere headlines will miss the actionable opportunity embedded within them. Those who understand the market mechanics, the leverage, the settlement risk, the supply-demand imbalances can position themselves to benefit, to protect, and to gain in a way that is far beyond the reach of average investors. So for anyone holding gold or silver, the takeaway is clear. Do not wait for certainty. Do not wait for calm. The time to act is now. Evaluate your positions, consider where exposure can be optimized, and prepare to execute quickly. In every crisis, the potential for profit exists alongside the potential for loss. The difference is insight, preparation, and the courage to act when others hesitate. The market is sending signals, and those signals are calling for action. The opportunity is real, and it is yours to seize if you are ready. What we are witnessing today in the gold and silver markets cannot be separated from the broader global economic picture. These metals do not exist in isolation. They are intrinsically linked to currency values, debt levels, central bank policy, and geopolitical tensions. When LBMA and COMEX release information that signals stress, it is not just a metals story, it is a reflection of the larger financial ecosystem. To understand the significance, you need to see the connections between these markets and the global economy, because those connections will dictate how investors are affected in the coming weeks and months. The first element to understand is inflation. Central banks around the world have been engaged in an unprecedented experiment in monetary policy. Low interest rates, quantitative easing, and massive government borrowing have created conditions where paper currencies are under constant pressure. Gold and silver, by contrast, are not issued by any government and cannot be printed or devalued in the same way. When inflation expectations rise, investors naturally turn to precious metals as a hedge. But what is often overlooked is that sudden policy shifts, whether tightening or easing, can create shocks in both paper and physical markets, driving volatility in ways that most retail investors are unprepared for. Then there is the issue of debt. Governments and corporations alike have accumulated record levels of leverage, and much of it is denominated in currencies that may be vulnerable. When debt levels become unsustainable, confidence erodes, investors begin to question the stability of the system, and markets react accordingly. Gold and silver respond not just to perceived value, but to the degree of trust in global financial institutions. LBMA and COMEX updates often highlight vulnerabilities in the infrastructure supporting trading and settlement. When you combine these vulnerabilities with high debt and fragile confidence, you have a perfect storm for sudden price movements. Global trade and geopolitics add another layer of complexity. Tensions between major economies, disruptions in supply chains, and sudden regulatory shifts can all impact metals markets indirectly. A policy announcement in Beijing, a central bank decision in London, or a geopolitical flare-up in the Middle East can create ripple effects in pricing and liquidity. When markets are already under stress, as signaled by LBMA and COMEX, even minor disruptions can become magnified. The interconnected nature of global finance means that no investor, regardless of location, is insulated from these effects. Currency dynamics are equally critical. The value of the US dollar, the euro, and other major currencies has a direct impact on the price of gold and silver. When currencies weaken, metals tend to rise. When currencies strengthen, metals can temporarily retreat. But these relationships are not static. They are influenced by central bank actions, trade imbalances, and investor sentiment. Understanding these dynamics allows an investor to anticipate potential moves and position accordingly. Ignoring them is a mistake that can lead to missed opportunities or unexpected losses. What this all means is that the news from LBMA and COMEX must be interpreted in a larger context. It is not just about supply, demand, or trading volumes. It is about systemic fragility in the broader economic currents that can exacerbate risk or create opportunity. When central banks adjust policy, when debt levels reach tipping points, when geopolitical tensions spike, metals markets respond disproportionately, and this is exactly why urgency is necessary. These moves can happen fast, and delays can be costly. Investors who understand the global context know that risk and opportunity are inseparable. Markets are signaling stress, but within that stress lies potential for strategic positioning. Those who recognize the macroeconomic pressures, inflation, debt, currency dynamics, and geopolitical risk can adjust allocations, secure physical holdings, and hedge exposures in a way that less informed investors cannot. Timing, discipline, and insight are essential. The key takeaway is that the precious metals market today is not isolated from the global economy. It is a reflection of confidence, leverage, and policy across the entire financial system. LBMA and COMEX updates provide critical clues about where the system is stressed, where liquidity might falter, and where opportunity exists. For anyone holding gold or silver, ignoring the global economic context is a mistake. Understanding it is the difference between protecting wealth and watching it erode, between seizing opportunity and being left behind. The world is entering a period of heightened uncertainty. Inflation, debt, central bank policy, and geopolitical tensions will continue to drive volatility in gold and silver markets. The signals are clear, the risks are real, and the opportunities are tangible. Those who grasp the connections between these global forces in the metals markets, who act decisively while others hesitate, will emerge with wealth protected and potentially enhanced. Those who ignore these signals will face consequences they did not anticipate. In times like these, understanding the global economic context is not optional, it is essential. So here's my message. Don't wait for the headlines to hit. Don't assume the markets will remain calm. Take stock of your exposure, consider your strategy, and act while you still have time. Gold and silver are more than investments, they are shields against chaos. And right now, the news from LBMA and COMEX is your wake-up call. Those who ignore it risk losing, and those who understand it can gain. Stay alert, stay informed, and most importantly, stay prepared. The opportunity and the danger are both here, right now.